Hello students, welcome to Mr. TK classes. In this class, we are going to do question 1 from FAC2602 September or November 2021 UNISA question paper. Our question reads, the following information pertains to Go Green Limited and Run Recycle Limited on 31 October 2020. These are our transactions. Required. Draft the following pro forma consolidation journal entries of the Go Green Limited Group for the year ended 31 October 2020. After taking the above mentioned information into account. A. Elimination of the unrealized profit included in closing inventory. B. Elimination of the unrealized profit and depreciation associated with the sale of the recycling machine. C. Elimination of the intra-group debtor and creditor balances. D. Elimination of the intra-group preference dividend. Please note, indicate clearly to which company each account refers to. Journal narrations and dates are not required. Show all calculations and round off all amounts to the nearest rand. Ignore the taxation effect on unrealized profits and or losses as well as capital gains tax. So basically our requirements are here: A, B, C, D. Okay, let's scroll up. All right, A, elimination of the unrealized profit included in closing inventory. All right, let's go through our transactions. Go Green Limited and Run Recycle Limited are operating in the recycling and sustainability market. On 1 November 2018, Go Green Limited acquired a 60% interest in the ordinary shares and a 30% interest in the 8% cumulative preference shares of Run Recycle Limited. Okay, so we need to write something down. Date of acquisition. Date of acquisition 1 November 2018. All right, financial year. Our financial year is as follows. Right, we can see our financial year ends 31 October 2020. All right, so this is the end. This is the end. 31 October 2020. And this is the start. 1 November 2019. All right. Okay. All right. All right. We can see that requirement A needs us to focus on inventory, right? And inventory is transaction number 2. Okay, let's read transaction number 2. Go Green Limited has always purchased all inventory from Run Recycle Limited. All right, let's write something down. Okay, Run Recycle Limited. Run Recycle Limited is the seller of inventory and it is selling to Go Green Limited. Go Green Limited, right? Okay. Go Green Limited has always purchased all inventory from Run Recycle Limited. Okay. So profits are in the books of the seller. Inventory is in the books of the buyer. Right? Okay. Go Green Limited has always purchased all inventory from Run Recycle Limited. Run Recycle Limited sells the inventory at a markup of 25% on cost. Okay. All right. So a markup of 25% on cost, which means that cost is 100%. Right. Then profit is 25%. Right. Profit is 25%. Which means that sales are 125%. Right? Okay. So Run Recycle Limited is selling inventory to Go Green Limited, which means that inventory is being transferred from Run Recycle Limited to Go Green Limited at 125%. Right? Okay. So the inventory that is in the books of Go Green Limited is at 125%. So if we want to calculate profit, we are going to say 25 divided by 125 multiplied by our inventory. Right? Okay. At the end of the current financial year, right? At the end of the current year, the inventory balances in the accounting records of the two companies were as follows. And we know that inventory that we want is in the books of Go Green Limited, right? So Go Green Limited, 940,000. On 31 October 2020, Go Green Limited had refuse bags amounting to 20,000 on site that were already sold to a customer, but the truck failed to deliver it on time. The accountant accidentally included this transaction in the inventory count. All right, so we are going to say 940,000 subtract 20,000. The reason why we are subtracting 20,000 is that this inventory was already sold to the customer. This inventory does not belong to Go Green Limited. Okay, so 25 over 125 multiplied by, or we can just do it this way, 940,000, because I'm using a standard calculator, subtract 20,000 multiplied by 25 over 125. 184,000. So this is unrealized profit. Unrealized profit in closing inventory. Right? 184,000. Okay. So we are going to credit inventory account. Right? We are going to credit inventory account in the books of who? In the books of Go Green Limited, because that's where the inventory is. Right? Okay. Go Green Limited. Go Green Limited. Okay. Right, so the reason why we are crediting 184,000 is that 184,000 is unrealized profit. It's not supposed to be part of inventory. Right, then we are going to debit cost of sales. Cost of sales. Right, so by debiting cost of sales, we are increasing an expense called cost of sales, which means that profit will decrease. So if expenses increase, profit will decrease. So we are decreasing our profit by 184,000 because this is an realized profit. We need to decrease our profit by 184,000. So profits are in the books of who? Profits are in the books of Run Recycle Limited. Profits are in the books of Run Recycle Limited. Right? Then we are done. We are moving on to B. Elimination of the unrealized profit and depreciation associated with the sale of the recycling machine. Okay? And that's transaction number 3. Go Green Limited sold a plastic recycling machine to Run Recycle Limited on 1 August 2019. All right. We need to write something down. Okay, so this was about inventory, unrealized profit in closing inventory, right? Unrealized profit in closing inventory. Then unrealized profit, and I can just copy here, right? Unrealized profit and depreciation, blah 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 blah. So I'm going to take that here. Okay, right? Okay. Go Green Limited sold, which means we are going to use the same logic as what we have here. So I'm going to take this, right? This time around the seller is Go Green Limited, right? The buyer is Run Recycle Limited. Right? And this is machinery, PPE, which is property, plant and equipment, machinery, right? Okay, so profits are in the books of the seller and the machinery is in the books of the buyer, right? Okay, Go Green Limited sold a plastic recycling machine to Run Recycle Limited on 1 August 2019, right? Okay, date of sale 1 August 2019, 1 August 2019, right? Which means that we need this here, right? Okay, 1 August 2019 is between the date of acquisition and the start of our financial year. So it is going to come here. It is between the date of acquisition and the beginning of our financial year. That's where 1 August 2019 is. Okay, the machine had a carrying amount, or the machine had a carrying value of 950,000 and was sold at a profit of 30,000. Okay, it was sold at a profit of 30,000, right? Before the beginning of our financial year, right? So profit of 30,000 is in the retained earnings account, because we know that all the profits that the business calculated before the beginning of the financial year are in the retained earnings account, right? So we need to eliminate this 30,000 because it is unrealized profit. So we are going to debit retained earnings account. Retained earnings account, right? 30,000, right? Retained earnings account has a credit balance. So once we debit it, we are decreasing it, right? Okay. So retained earnings in the books of who? In the books of Go Green Limited, because that's where profits are, right? That's where we have our profits. So we have to debit retained earnings in the books of Go Green Limited, right? Then what is the other leg? The other leg is property, plant and equipment, machinery. 30,000. So here we are saying our property, plant and equipment should not include 30,000 because it's this 30,000 is unrealized profit. So it shouldn't be included in our property, plant and equipment, right? So property, plant and equipment is in the books of who? Is in the books of Run Recycle Limited, right? Is in the books of Run Recycle Limited. Okay, right? Then we can see that the date of sale is 1 August 2019, right? And the financial year end is 31 October 2020, right? Which means that this machinery depreciated. This machinery depreciated from the date of sale until financial year end. So every time this machinery depreciates, we are going to state back that profit that we said it was unrealized before. Now, when the machinery depreciates, we treat that as realized profit. So every time the machinery depreciates, that profit is being realized. So we are going to say from 1 August 2019, right? From 1 August 2019 up to the start of our financial year. Let me just take this, right? Up to the start of our financial year. This is how many months? August, September, October. We can't count November because this is 1 November. So we have 3 months, right? Then from 1 November 2019 up to the end of our financial year, that's 12 months. 12 months. So we are going to calculate depreciation for 3 months. We are going to calculate depreciation for 12 months. So we are calculating our depreciation on that unrealized profit, which is 30,000. So we are going to say 30,000 multiplied by, right? We can see that it is the group's policy to write off depreciation on the machinery at 28% per annum, according to the reducing balance method. So multiply by 20%, multiply by 3/12, right? Multiply by 3/12 because we are calculating for 3 months. 30,000 multiplied by 20% multiplied by 3/12, 1,500. Okay, let us calculate depreciation for 12 months. We are going to say 30,000 subtract 1,500. The reason being we are using reducing balance method, right? Okay, multiply by 20%, right? There's no need to multiply by number of months because this is 12 months. 30,000 subtract 1,500 multiply by 20%, 5,700, right? So these 3 months are in the previous financial year, which means that this 1,500 affected our retained earnings, because we know that all profits from the previous financial year are in the retained earnings account, right? Then this one affected profit for the year. Profit for the year, because this is our current financial year, right? So since we said every time the machinery depreciates, profit has to be stated back, right? It has to be added back because it's now realized. So this 1.5 will come here. We are going to credit 1,500, right? We are going to credit 1,500. Then this is going to be retained earnings. Remember, retained earnings has a credit balance, right? So when we credit it, we are increasing it. So this is realized profit that we are now adding back. So this is in the books of Go Green Limited, right? Alternatively, you can come and check here. Profits are in the books of Go Green Limited, right? Then for the current financial year, 5,700, we are going to credit depreciation account. So depreciation is an expense, and expenses have a debit balance. So once you credit depreciation, you are decreasing depreciation. Decreasing depreciation means decreasing an expense or decreasing expenses, right? So if you decrease your expenses, profit will increase. So we are actually increasing our profit, right? In the books of who? Of Go Green Limited. Alternatively, you can come and check here. Profits are in the books of Go Green Limited, right? Then the other leg is meant to address this, right? So we need to increase our property, plant and equipment. So we are going to increase our property, plant and equipment using an account called accumulated depreciation, right? Accumulated depreciation. So we are going to add these two amounts, 7,200, right? So we are going to increase our property, plant and equipment in the books of Run Recycle Limited. Alternatively, you can check here, right? Property, plant and equipment in the books of Run Recycle Limited, right? So what we did at the time of sale, we decreased our PPE, we decreased our retained earnings, right? Because we said this is unrealized profit. But when the machinery starts to depreciate, we'll start adding back that profit that we're saying it was unrealized. So at this point in time, we have already added back 7,200, which means that our property, plant and equipment will increase, our profit will also increase, right? Then we move on to C, elimination of intra-group data and creditor balances, right? Okay, and that's number 4. Run Recycle Limited has a data balance of 1,100,000 and sells to main customers, including Go Green Limited. Go Green Limited has a creditor balance of 450,000, resulting only from purchases from Run Recycle Limited. So the balance that is between them is 450,000, right? So let's start with this company, Go Green Limited, right? So we need to eliminate 450,000 because it is an intra-group balance, right? So in the books of Run Recycle Limited, this is a data balance, right? So debtors are assets. So if we need to eliminate them, we are going to credit them. So we are going to say trade receivables control, right? This is also called debtors control, and this is in the books of Run Recycle Limited, right? We can see that here. We can see that here. Data balance Run Recycle Limited. Then creditor balance, this is a liability. So if we want to eliminate that, we are going to debit trade payables control. So trade payables control is also called creditors control, right? 450,000. And this is in the books of Go Green Limited. So let me just copy here, Go Green Limited, right? Then we move on to D. Run Recycle Limited. Run Recycle Limited's preference share capital amounts to 700,000, which means we are going to calculate our preference dividend on this amount, right? No preference dividends were in arrears on 1 November 2018. Okay, let's scroll down. Okay, let's address our preference dividends here. Preference dividends. I want this, right? Okay. Going to remove this. This was about PPE. Just want this one. Okay. Run Recycle Limited preference share capital amounts to 700,000. No preference dividends were in arrears on 1 November 2018. So no preference dividends were in arrears on the date of acquisition. All right. Okay. At year end, on 31 October 2020, Run Recycle Limited declared and paid all outstanding preference dividends. Okay. Right. So no preference dividends were in arrears on this date. Okay. Then they paid again on the 31st of October 2020, which means that they were paying for 2 years. Let me take this date and bring it here, right? So basically this is the start of previous financial year. Right? This is the start of the previous financial year, right? Okay. So they paid dividends for 2 years, for previous financial year and for current financial year, right? So let us make use of these analysis tables. Let me see. Okay, all right, nice stuff. Okay. Is there any space there? No. All right, it's fine like that. Okay. This is ordinary shares, and this is preference shares, right? And this is preference shares. I can as well just do this. Okay. All right. Okay, this looks good. All right, so we need to go through transaction number 1. We need to go through transaction number 1. Okay, Go Green Limited and Run Recycle Limited are operating in the recycling and sustainability market. On 1 November 2018, Go Green Limited acquired 60%, Go Green Limited acquired 60%, right, which means NCI is 40%, interest in the ordinary shares, and a 30% interest in the 8% cumulative and a 30% interest, right, which means NCI is 70%, in the 8% cumulative preference shares of Run Recycle Limited, right? Then on the date of acquisition, the revaluation surplus and all these things, okay? Right, so we have already found the percentage that we were looking for. We're looking for this, right? So these preference shares are called 8% cumulative preference shares. So what cumulative preference shares mean is that if dividends are skipped, they will be paid when profits become available, right? That's why this transaction is saying Run Recycle Limited declared and paid all outstanding preference dividends. So they paid for 2 years because this is cumulative preference shares, right? Dividends for the previous year were skipped, so they were paid in the current financial year, right? They were paid in the current financial year because if dividends are skipped, they will be paid when profits become available, because this is cumulative preference shares. The dividends will be paid when profits become available. All right. Okay, so the percentage is 8%, and the amount of preference share capital is 700,000. So we are going to say in our ordinary shares analysis table, we are going to say area preference dividend, right? Area preference dividends, right? Area preference dividends, 700,000 multiplied by 8%, right? 700,000 multiplied by 8%, 56,000, right? Okay, so the reason why we have this here under since acquisition up to the beginning of current year is that dividends were last paid up to 1 November 2018, which is the date of acquisition, right? So we have dividends that are between since acquisition up to the beginning of current year, and we also have current year. So basically this is previous year in accordance to this question, because remember we said dividends were paid for 2 years at once. So we are going to take out this 56,000, right? We are going to bring it here. We are going to bring it here. since acquisition up to the beginning of current year. We are going to bring it here. Then we are going to call this preference dividends. Preference dividends. Right? So the reason why we are doing this is that profit attributable to preference shareholders is transferred from ordinary ownership analysis, right? Which is this. We are transferring profits from this, right? To preference ownership analysis, we are transferring to this, right? Okay. So that it will be distributed as dividends according to the percentage of interest in the preference ownership analysis, right? So remember, we record our retained earnings in ordinary analysis. That's where we record our retained earnings, and that's where we record our profit for the year, which means that there are no profits in this table. And we want to declare dividends in this table for preference shareholders, right? So we should take out the profit from this table and bring it here. Then we'll be able to declare dividends, right? So this was for the previous financial year. For the current financial year, we are going to say preference dividends, right? And how much is that? It's still gonna be same calculation. So same calculation, right? Sorry, supposed to bring that here. Okay, right? 56,000. Then that 56,000 should come here under our current year, right? This is attributable profit, right? This is attributable profit. Okay, so let us come back here. All right, let us just quickly do these calculations. All right, okay, 56,000 multiplied by 60%, 33,600. 33,600, which means even here 33,600. Then 56,000 multiplied by 40%, 22,400, right? 22,400, which means even there 22,400, right? Okay. All right, then let us come here. 30% of 56,000, 16,800, right? 16,800, which means even here 16,800, right? Okay, then here 70% of 56,000, 39,200, 39,200, and 39,200, right? Okay, so before we declare our dividends here, right? Before we record the declaration of dividends, let's journalize this amount and this amount, these two amounts that are under NCI. Let's journalize them. We can see that we have 39,200 there. Okay, and it is between since acquisition up to the beginning of current year, right? So remember, this is profit that we brought here, so that we'll be able to declare dividends, right? Okay, so this affects retained earnings, this amount, because it is between since acquisition up to the beginning of current year, right? So what we are going to do, we are simply transferring that amount from retained earnings. So we are going to decrease our retained earnings, because we are transferring from retained earnings. The amount is on my clipboard, right? Then we are transferring this to non-controlling interest. Non-controlling interest, non-controlling interest, right? Non-controlling interest in the statement of financial position, right? 39,200, 39,200, right? So whenever we write non-controlling interest in the statement of financial position, we should also write that amount in our NCI column, right? Okay, so this retained earnings is in regards to preference shares, right? Okay, then we need to journalize the second one. Right? But this is not retained earnings, because this is in the current financial year, right? So okay, this one we already know that non-controlling interest in the statement of financial position, right? Then this is non-controlling interest in the statement of profit or loss or other comprehensive income. So this is non-controlling interest in the statement of profit or loss and other comprehensive income, right? Because it is in the current financial year. This one is in the previous financial year, right? Okay, then let's go back, right? Okay, so Run Recycle Limited declared and paid all outstanding preference dividends. So this is about declaration of dividends. So I'm going to say preference dividends, right? Okay, declared and paid all outstanding dividends, 56,000 plus 56,000. This is all outstanding, right? Okay, 112,000. Then here 16,800 plus 16,800, 33,600, 33,600. Then here 39,200 plus 39,200, 78,400. Okay, let's check arithmetical accuracy. 78,400 plus 33,600, 112,000. Okay, right? So now we need to journalize this. Right? So 33,600 was paid to the parent, right? So this is an intra-group transaction. We are going to eliminate that by debiting dividends received, right? That amount. Okay, then the parent is Go Green Limited. Let us go back. Right, this was paid to the parent, Go Green Limited. This is the parent. Take that. Right. Okay, come back here. This was paid to the parent, Go Green Limited. Okay, then we are going to credit dividends paid. Right, dividends paid by Run Recycle Limited. Run Recycle Limited, where's that? I'm just gonna copy here. Right, so Run Recycle Limited paid a total of 112,000. So we are going to come here. They paid a total of 112,000. Right, okay, then we are going to debit non-controlling interest in the statement of financial position. Right, 78,400. 78,400. 78,400. Right, then debiting non-controlling interest in the statement of financial position means that we are decreasing a non-controlling interest in the statement of financial position. Okay, so this is what we were required of in this question, right, which is question 1 from FAC2602 September or November 2021 UNISA question paper. Thanks so much. Let's meet in our next class or in our next episode, right, where we'll be solving question 3. We are going to solve question 3, right, which is a statement of cash flows. Thanks so much. I'm out.